I guess what I'd like to do is just set the scene a little bit and give a bit of context to why we're here. Given that superannuation funds typically invest on average, say 12% of their funds in infrastructure assets, why is it that we're focused on the topic today? Certainly Alan Kohler, in one of his comments earlier in the year, certainly brought everything into context. In an article that he wrote back in February, which I'm sure many of you will have probably seen, called Superfund Whiplash, he basically concluded with the comment that if you've got membership of a unlisted fund with a significant exposure to infrastructure assets, you should get out while you can. He also made some pretty strong comments in that article along the lines of things like, Australia's superfund managers are the Wizards of Oz, quaking behind a curtain of unlisted asset valuations and waiting for Dorothy to pull the curtain aside and expose their pitiful reality. He went on to say, superfund returns have been bad lately, right? Wrong. They've been fabulous. So good, in fact, that they're actually an illusion. And then he went on to say, the listed version of the fund's unlisted assets have all collapsed in value. But in many cases, the unlisted valuations reflected in the value of the core fund have not moved, or even in some cases have gone up. And then his conclusion as a result of all of that was, get out while you can. I guess we're asking the question, was that sensible advice? Rather than specifically answering that question now, what we'll do is take you through a little bit of a valuation journey, if you like, give you some insights into some of the issues and help you understand some of the challenges and how we recommend they be addressed. And then at the conclusion of the presentation, we'll come back and give you our thoughts regarding whether or not that was sensible advice. So what are we going to cover? Basically, there's four areas. As Karen mentioned earlier, it's how infrastructure assets are valued, what are the key drivers in valuing infrastructure assets, how is the current market impacting upon their value, and what is best practice in infrastructure valuation. Recognising that there's actually a large audience and two, quite a divergent group here, trustees, managers and other people with different roles in the industry, we'll try as much as possible to sort of draw out the key message in each particular area that we're focusing upon, and then delve into a little bit of detail, but not so much detail that we send you to sleep.
Now, at the risk of losing everyone within 5 minutes of lunch, we're going to start with talking about the definition of value. Up on the screen, we've got two relevant definitions, the one that applies to broad businesses, fair market value, and a second definition, net market value, which really relates to this audience. Now, in summarizing these definitions, when we talk about value, obviously we're talking about a dollar amount. As part of both of those definitions, we're saying we're not looking at a specific buyer. What that effectively means is that we aren't including any synergies that can be attributed to one specific buyer. We'd be looking at a collection of buyers. The definitions also point to the fact that the willing buyer needs to be knowledgeable, which means that they need to have had time to perform due diligence. And finally, the definitions mean that really we're not talking about a fire sale scenario. So in this crisis we're in, the challenge we as valuers have to deal with is where we see market evidence of transactions occurring, we need to confirm in the current market that they're not fire sales. Now, in terms of what is relevant to this audience, in looking at net market value, a fair question that trustees can ask of their management is, are we doing the right job of estimating realisation costs? Net market value requires realisation costs to be deducted. And I think there is a risk in the Australian super fund market, being that we could ascribe a value to a 20% stake in an infrastructure asset, and there might be another super fund that has a similar stake, and they might actually be carrying them at different amounts because they're using different realisation costs. Now, our view is that the realisation cost should be based on a weighted mechanism. There is a fair chance that a super fund could sell to an existing investor. That's through the preemptive right process. There's also a fair chance that you could go and find a third party. Now, the cost of selling to a co-investor tends to be quite low, and the fees that would be paid to an investment bank to facilitate a sale process could be quite high. So we would recommend a weighted average approach and make the suggestion to you that you explore this with your management teams to ensure that they're applying this sort of lens.
I guess what you've got on the screen there is a slide showing 4 values. On the far left-hand side, you've got the value of an asset to the existing owner of the asset, to the seller of the asset. And then let's assume that there are 3 potential purchasers, or most logical purchasers of that asset, purchasers A, B, and C. And it's obviously worth a different amount to each of those different purchasers, usually reflecting the extent to which there are synergies or their level of optimism in relation to the prospects for that asset or what they could do to improve its financial performance. The concept of market value requires a valuer or trustees to be thinking about the price that would be negotiated if the seller, to whom it's worth the least, was to sell that asset in the open market, assuming that nobody's anxious, everybody's informed. Think about for a moment, if you will, what the market value would be conceptually under that scenario where you've got 3 prospective purchasers to whom it's each worth A, B, and C. Who would be the buyer and what price would they pay? I put it to you that the purchaser would obviously be purchaser C, because they're the ones to whom it's worth the most and who can afford to pay the most for the asset. The price that you would probably negotiate would be a price marginally higher than what it's worth to buyer B, because purchaser C has only got to pay a little bit more than purchaser B can justify paying, and they'll obviously get it because purchaser B can't justify that price. So conceptually, you're thinking about the price that would be negotiated, having regard to the sort of people who would be in the market to buy the asset, the prices that they'd be willing to pay, and the market value being somewhere marginally above what it's worth to the sort of second most attractive buyer.
We have one more definition for you, and it's enterprise value. And the reason we want to introduce it to you is it's going to be a foundation to the slides that follow. Enterprise value is simply the fair market value of debt plus the fair market value of equity. Now, there are many different approaches to value, and we've listed 4 here. Obviously, the most simplistic approach to apply would be a PE ratio. It's been used for over 100 years now. Another common approach is an EBITDA multiple, and that's a slight refinement on a PE ratio. With the introduction of the international accounting standards, I think discounted cash flow methods have probably become more commonplace. DCF is the common acronym, and the most common application of a DCF is to forecast earnings or a cash flow for a business, and under the accounting standards, they suggest calculating a WACC and calculating a net present value or NPV. Now, the international accounting standards were introduced in Australia about 3 years ago, and most companies have to perform impairment tests on an annual basis. So it's been quite good from a market standpoint, because now there are a lot more market participants out there who are actually familiar with the DCF method and use it on a regular basis. In valuing infrastructure assets, we use method 3 as our primary method. It is DCF based, but we don't use a weighted average cost of capital. We model debt and cash explicitly, and we convert those leverage cash flows or equity distributions or dividends at a cost of equity. So it's the most complex out of all of these. The key cross-check to that method is the EBITDA multiple. So on one hand, we've got a method, a DCF calculating an equity value, and on the other hand, we've got a multiple giving us an enterprise value. We simply deduct debt from the enterprise value to match the two up. Now, an important factor is that valuers need to apply a number of different methods. As I've said, in infrastructure, we apply those too. But I really would have concern for anyone who's valuing businesses, your typical widget manufacturers using a PE ratio. I'd say that the market has moved on from that point.
What we've got up on the screen there is a sort of a diagrammatic summary of the 2 most commonly applied methods. As Paul just said, discounted cash flow is absolutely the primary method that we would use in just about every valuation that we perform these days. We also recognise that DCF is like just about anything. It's a case of garbage in, garbage out. You can come up with some ridiculous results with apparently reasonable assumptions, But if you make a whole heap of apparently reasonable assumptions that are all actually just a bit off the mark, you get the compounding effect, so that when you get the end result, theoretically it all stacks up, but in reality it's absurd. And therefore it's critical that in any valuation there is always a sanity check applied to the results of a DCF analysis. And that's where the market comparable approach is particularly useful. Rather than working through that slide in detail, what I would really like to do there is probably just highlight the fact that when you're looking at the DCF steps, the second box from the bottom there is projected leverage cash flow. There's actually a lot of work and effort that needs to go in by anybody who's valuing any asset in getting to those cash flows. It's not simply a case of just taking some cash flows and applying a discount rate. There is a hell of a lot of analysis that should be done to make sure that those cash flow forecasts are reasonable. It's hard enough to forecast 12 months out. The DCF valuations that are being performed will typically have somewhere between 20 years and 40 years worth of explicit cash flow forecasts. Those forecasts can be horribly wrong, and that's why there's so much effort that's actually put into comparing those forecasts with the historical performance of the asset as well. So we would be saying that any valuer who's doing a decent job, whether they be an independent valuer, whether they be part of a management team that's responsible for the management of a fund, needs to be spending a hell of a lot of time looking at those forecasts and understanding how they fit and do they make sense in the context of the past performance of the business. Just to make sure that everybody has a basic understanding of DCF analysis, there's really only 4 steps to a discounted cash flow. It's a pretty straightforward process at the end of the day. Firstly is calculating the cash flows that you think that a particular asset is going to generate. Secondly, it's determining the appropriate risk-weighted discount rate at which those cash flows are discounted back to present value terms. Thirdly, it's determining the terminal value. Obviously, you're only forecasting cash flows for a certain number of years, but generally speaking, the asset that you're valuing has got value beyond that period in which you're forecasting explicit cash flows. So you have to work out what it's worth at the end and determine that value as well. And then finally, once you've got those 3 things, you convert everything back to a present value. Conceptually, it's actually very simple. The challenge is in making sure that the process is undertaken robustly.
So now we'd like to provide a brief recap of how to go about estimating the cost of equity or the discount rate. This is the rate that takes future cash flows that are forecast and the terminal value and turns them into today's dollar terms. So this discount rate needs to capture risk elements. It's based on the capital asset pricing model. Now, the capital asset pricing model is quite simply the risk-free rate, so the rate of return that you could get for taking no risk in the market. In Australia, we use the 10-year Aussie government bonds, plus beta times by a market risk premium. Now, the market risk premium that we tend to use in Australia is 6%. And beta captures the sector risk, the risk of investing in a specific asset, and it really measures that risk against other market options. Now, the key drivers underpinning the capital asset pricing model are threefold. Firstly, there is beta. Secondly, there is gearing. And thirdly, there is size. Now, I guess a good question a trustee could ask is, what sort of asset betas am I looking at in my infrastructure portfolio? Because you want to get comfort that that risk element is married up against other assets. For instance, I would expect the beta for a gas distribution network to be a lot less than the beta for an airport. The reason is that there is more patronage or volume risk in looking at an airport than there is a gas distribution network. Similarly, a water utility would be a lot less risky than a wind farm. So the beta captures that element. We as valuers who do a lot of work in infrastructure know that the typical asset beta for an airport is about 0.6. We know that utilities could go down as 0.3. We know that wind farms might be 0.7, and container terminals and ports maybe 0.7, maybe a bit higher. So we have that background and that experience. The next element, and what really makes the DCF applicable now in this market more than ever, is that it captures gearing. Now, Gearing is something that we incorporate because as an equity investor, if there's more gearing in an asset, there's more of a risk that you might not get a return. The higher the gearing, the higher your required rate of return should be. And that is a key driver that's captured in this CAPM framework. And finally, size. If you invest in smaller assets, your returns should be greater. There have been studies done in the world's developed markets since the 1920s, and they demonstrate that by investing in smaller assets, you would tend to earn a greater return. Over the long term, you'd expect small cap funds to outperform large cap funds for that very reason. And those same principles apply. So when we're asked to estimate a discount rate for an infrastructure asset, the scenario might be you're considering a major acquisition, the investment case analysis is showing an IRR of 13%. Does that stack up? We would be applying this framework, looking at these three drivers in particular, and hopefully providing a logical response. Now, we're not property experts, Mark or myself, but our property experts at PwC are actually advocates of taking this CAPM framework and applying it to value property. Their reasons are simply that there's a lot more science, and this is based on market evidence and market observations. It is proven, it's generally accepted corporate finance theory, and it could be a good substitute to rules of thumb that have applied in the past when the market was quite deep. But now that the property market is shallow, this could be a good substitute. It might be a short-term substitute for estimating a cap rate or some other discount rate, and it might even be something that would end up being used in the long term. Now, when valuing infrastructure, we need to be aware of two things. There's risk in estimating the discount rate that we've just talked about, and we've presented those on the right as cost of capital drivers. There are also cash flow drivers. You can't just take the cash flows and discount them. We've presented on the left-hand side there, the cash flow drivers could be volume and patronage risk. Now, we're looking at a number of ports right now, and volumes are down 10%. That's a lot more than what we would have expected for these cornerstone assets. I think volume and patronage risk is also relevant to the tunnels around Sydney and other parts of Australia where there were certain acquisition models that assumed certain levels of volume and patronage coming in pretty quickly, and they weren't realised. So it's really at the top of our list in terms of a key cash flow driver. The next cash flow driver is leverage and debt refinancing risk. And regrettably, if we take a look at Babcock & Brown Power right now, with a market capitalisation of 47 million and total debt of 3.3 billion, I think they're really feeling this risk loud and clear at present. There is also construction and ramp-up risk. That sort of ties into volume, especially on the ramp-up side. Investing in a construction stage asset is a lot more risky than investing in an asset that's been up and running and has proven cash flows. Scale and growth prospects are relevant. When we look at marrying up a Brisbane airport to a Melbourne airport, Brisbane's got stronger growth prospects. It's also got a second runway coming on. That's going to drive greater cash flows, and that's a key value driver. Whereas Melbourne, the growth is a little bit more constrained. So as a cross-check, the EBITDA multiple that we'd expect to see on Brisbane Airport would be higher than what we would see on a Melbourne airport. On the right-hand side, we highlight a few other cost of capital drivers. We've talked about leverage a little bit, but we've got a slide in a few moments that'll hopefully bring that point home. Now, what makes infrastructure unique? What makes it different to property? Well, to quote an infrastructure fund manager in Sydney, he's a big fan of Sydney Airport, and he says, there is only one Sydney Airport. I can invest in lots of different commercial property buildings around town, but there's only one Sydney Airport. And that Sydney Airport and most other infrastructure assets, that is core infrastructure assets, have a few distinct features. They tend to be monopolies. There tend to be barriers in place that protect those cash flows and help ensure certainty of cash flow. There tends to be inelastic demand such that if there is a given increase in price, the reduction in volume tends to be less than that change in price. And finally, they tend to have a long life. Now, property don't tend to have all of those elements. They're quite often missing monopoly characteristics, barriers to entry, and potentially inelastic demand. They tend to have long lives. Now, with these building blocks in place, we've seen something emerge, especially in the last 5 years, and that is the infrastructure definition being extended. It's gone beyond airports, ports, toll roads. It now includes parking facilities. It now includes highway service centres. It includes storage facilities. Those are what we would call hybrid infrastructure assets. So they don't have all of these building blocks in place. There is evidence in some markets, some developed markets, we've seen it in the UK recently, where trying to sell a hybrid infrastructure asset is a lot harder than trying to sell a core infrastructure asset. So the IRR that one could expect to achieve if selling one of those assets would be a lot higher than if it was a core infrastructure asset.
Paul touched upon the fact earlier that leverage is one of the factors that is very relevant in determining the risk and therefore the required returns. Just ask you to consider for a moment, those of you in the room who are trustees, if somebody comes to you with a recommendation that the fund invests in a particular infrastructure asset, how would you be thinking about whether or not that investment is expected to give you an adequate rate of return? Would you be the sort of organisation that says, we have a standard threshold for this particular asset class, and so long as the investment is expected to generate a return in excess of that threshold, then I'm okay, I'm happy? If you are that sort of organisation, then I think you probably need to change your thinking. Because by the very nature of infrastructure assets, they do have some very predictable, stable cash flows. And as a result, they're able to be financed with debt much more heavily than many other businesses. And in many cases they are. We often see infrastructure assets with substantial leverage inbuilt within them. And that extra debt that they can carry substantially increases the risk of the asset, the risk of an equity investment in the asset. And therefore, it's really important that when you're thinking about the returns that you can expect to receive from investment in any asset, frankly, but particularly infrastructure assets, that you understand what is the implicit leverage within that investment in the first place. What we're showing on that table there is just a simple illustration of the point. We've used the standard formula that we use for calculating what impact leverage has on cost of equity. It's called the Harris-Pringle finger formula. It's not called the Harris-Pringle finger. What we're showing there is the cost of equity at different levels of gearing. So you can see where the asset is 40% geared, the cost of equity should be 11.3% for this particular asset. As gearing increases to say 60%, which frankly is not uncommon for an infrastructure asset, the cost of equity increases to 14%. So if you've got a threshold rate of return that needs to be exceeded of say 12%, you might see that this asset is expected to generate a 14% return, and you'll think it's a sound investment. But actually, because of the extra gearing that's sitting in it, it's not a sound investment. It would be a sound investment if it was generating 14%, but not if it was generating 13%, even though that 13% was above your own threshold. There's another point that I want to make here, and that is you can see that the relationship is actually non-linear. This is not a straight line. As the levels of debt start to increase to some of the very high levels that infrastructure assets have certainly in the past and may in the future be able to carry, the cost of equity starts to increase pretty substantially when you get up to those higher levels of debt. So I guess the basic message here is don't just think about infrastructure assets as a class and a required rate of return for investment in that class. Make sure that you understand the level of gearing implicit in any investment, and make sure that the people that are making the decisions can explain to you what impact that gearing is having upon the required returns, and be able to demonstrate that it is generating returns in excess of that requirement. Another point that Paul touched upon earlier was the stage of development of an asset. There have been a number of Australian funds that have been burnt investing in early stage assets, as Paul mentioned. Investment in toll roads and tunnels and the like has been a fairly tough experience for those who tended to invest in them in Australia. Why is it that, given that a number of people have been burnt, that early stage investments are still so popular? I guess it's basically for two reasons. Firstly, over time, if the asset proves to work as you hope it will work, and as the asset proves itself, the required rates of return will come down. Obviously, a development asset, as Paul said, has more risk attached to it than an asset that's in the ramp-up stage, and an asset in a ramp-up stage has got more risk to it than an asset that's already proven the cash flows that can generate. As that risk comes down, so too does the required rate of return from investing in that. So if you get in early and you can get it to the point where it's actually proving to generate the sort of returns that are expected, then as the required rate of return comes down, the value goes up and there's a hell of a lot of value to be gained. Not only do you obviously get the benefit of the reduction in the cost of capital, but you obviously also get the improvement in the cash flows that the asset generates over time. So you're actually getting a double whammy. You're getting improved cash flows, a reducing required rate of return. The sum of the two can be very, very healthy capital appreciation. So if you get it right, investment in early stage assets can be very, very successful, but it's not easy to get it right. And coming back to my earlier point about the work that needs to go into the forecasting of the cash flows, that point is sort of magnified tenfold when you're thinking about investing in an early stage or startup asset.
Here we present what we call the listed, unlisted disparity. The fact that when we ascribe a value to an unlisted asset and we put the name of PwC behind that valuation, the implied EBITDA multiple might be materially different than what we're seeing for listed airports around the world. On the lower chart, we present multiples as at June 2007. And you can see a regional airport, Auckland, was trading at about 16 times EBITDA. Birmingham Airport was bought for around 20 times EBITDA within the 12 months prior to that. Now, that gap can be explained by a control premium. To take over an Auckland airport, you would need to make an offer that would include a control premium that would most likely be approximately 20 times EBITDA. So there really wasn't a disparity in the market. It could be explained by sound financial theory. The problem is at present, as we see in the chart above, as at June 2009, on the right-hand side, listed airports in the developed world are trading at below 11 times. Auckland Airport is now at 11 times. Fraport, which is Frankfurt, is 7.4 times EBITDA. Flughafen Zurich Airport is 5.8 times EBITDA, and Vienna Airport's 5.4 times EBITDA. We as a firm have been issuing valuation reports during this period saying that the valuation is between 12 and 16 times EBITDA for Australian airports. So we are in fact reinforcing this disparity. Now, partly the reason for that is that we actually see evidence of the disparity. When we look at parcels of unlisted assets being bought and sold, we see Cairns Airport 15 times, we see Mackay at 27, very healthy multiple. We see Belfast City at 25, 26 times. So this disparity does exist. I guess there is smoke behind Alan Kohler and that article that he wrote. Now, in looking for possible reasons why there is a disparity, we've considered the correlation between listed infrastructure assets and the broader equity markets. As you can see here, we've got the green line, which is the MSCI World Index, and then we present a blue line, which is the UBS Global Infrastructure and Utilities Index. And although the utilities outperformed for a little bit in the middle of 2008, and there might have been a bit of hype around that, from our reading of this chart at least, we think there is a strong correlation. Now, going into a recession, we would expect infrastructure to outperform. Infrastructure assets have more stable cash flows, there's more certainty, there's less risk. But they haven't outperformed, at least from a listed market standpoint. And the reason is because the crisis we're in is all about leverage. That's the fundamental issue, access to leverage. Now, we would speculate that the reason there is this strong correlation and listed assets haven't outperformed and the multiples on the chart that we've just seen aren't higher for listed assets, we suspect the reason is that anything that is listed that has some leverage in it, moderate to high leverage in the case of infrastructure assets, is being adversely recognized by the market. Now, there's probably a good reason for that. That doesn't mean the listed market is behaving in in an unexplained fashion. The fact is that the information that's available around refinancing risk in the market tends to be less than what you would expect to get if you conducted a thorough due diligence process on an unlisted asset. The information we get as valuers when we value an unlisted asset is significantly greater than what listed companies disclose to brokers and the market in their presentations. So we believe the difference is explained by quality of information. Listed investors and asset managers managing listed funds really they don't have the full information to capture refinancing risk and other risks specific to the underlying asset. Whereas in a due diligence process for an unlisted asset, that information is greater. Just to prove the point, in speaking with one of the fund managers in town, they explained that they were frustrated because they asked an equity analyst for a model on Transurban, and the equity analyst shared his model, and it was just one sheet. It was quite a few rows deep, but it was just one sheet on several different toll roads for Transurban. If we were to look at a toll road model, there'd be 20 plus worksheets, there'd be 400 rows deep. I mean, the problem we face often is that the models tend to be too big. We're looking at one right now which is 175 worksheets and 250 megabytes. So there is a big distinction in information.
Paul talked about that disparity. One of the things we then thought about was, when do we see some form of convergence occurring? And so we did a little bit of work looking at past bear markets and the period of time that elapsed between the peak, the bottom of the bear market, and when the next peak was reached, or not the next peak, when a point equal to the earlier peak was reached again. And we've plotted on that diagram there a number of different bear markets. Probably the one that we're in at present is the blue, and hence the dotted lines with a question mark as to what the path of recovery might look like. You can see the depth of the drop. I don't have my glasses on, but it looks as though it's dropped down to just below 0.5 times what it was at the peak. Two other markets experienced sort of similar levels of decline. That was 1972, and then obviously the most famous of all of our crashes, 1987. Both of those were reasonably similar in severity to the decline that we've experienced. Interestingly, both of those took 6 to 6.5 years to return to the levels of the peak prior to the crash. If there's any correlation at all between the severity of the decline and the time it takes to recover, then if I was a betting man, I'd be putting my money on the market taking 5 years or so to get back to its previous peaks, rather than a shorter period like some of those smaller declines. Just to give you a bit of a guide as to what sort of returns that implies, we did some analysis that suggests that if it takes 2.5 years to recover from the depths to the previous peak, then that would equate to an IRR, if you invested at the bottom of the market, of approximately 30% per annum over that period of time. If, on the other hand, it takes 5 years to get out there, then that equates to a return of roughly 10% per annum to reach the peak again. Paul touched earlier upon the cost of capital, and one of the important factors in determining the cost of capital is the market risk premium. How much of a premium do you want for investing in equity as compared to investing in government bonds? Traditionally in Australia, most valuers have said that the premium is somewhere in the order of 6 to 7%, and most valuers have chosen 6%. In light of the global crisis, many people were asking us, has that premium changed? To cut a long story short, I think the answer is no. We as a firm believe that the premium has been and still is roughly 6%. It's hard to know exactly what it is, but we continue to use 6%. I think the cash flows that people are expecting to get from the investments have obviously dropped substantially, but fundamentally we don't believe there's any long-term change in the premium that you would expect for investing long-term in equities as compared to bonds.
In the current market, there are some bear traps, and we're going to get technical on this slide and the next slide. What we present on this chart is a highlighted orange area, and to get to the point, about a few months ago, maybe 3 or 4 months ago, we were seeing inflation implicit in the risk-free rate in Australia being less than what we were seeing in forecasts on infrastructure assets. It was about 80 basis points different. So there is a need for there to be alignment between the inflation assumptions built into a discount rate and those built into the model. You can't simply take a risk-free rate at face value. Another trap that we've observed is that capital structures can vary wildly. In this case, we present the capital structure for a wind power generator. Its capital structure has gone from 15% debt to 85% debt. We as valuers, as I mentioned earlier, look at gearing specifically. In the good old days, pre-credit crunch, we would have simply taken the capital structure on the valuation date. We're now having to change our methods to capture 5 years of data. If you're interested in speaking about this later, I'd be happy to take some questions on it. Now, liquidity is something that underpins our analysis. We showed a chart a few moments ago with some multiples of unlisted assets, and here we present a summary of the transactions we've observed. There is evidence of liquidity in infrastructure. We've seen 41 deals completed in the financial year ending June 2009. That is the blue bubble. Those deals were done at an average of 11.5 times EBITDA in the infrastructure space. That quantum of deal, 41 in the year completed, is roughly close to what we saw in 2005, where there were 43 deals. We see that there were two big market hype years. They were 2007 and 2008, where there were almost double that amount of deals. But at least for the meantime, we as valuers are comforted by the fact that there is good deal activity, and we would be concerned around liquidity if we saw half of what's been presented.
I think we're probably about to wrap up in a moment. So in answer to that first question, is Alan Kohler's advice sensible or not? I think, like many things in life, it depends. If a sound valuation process involving regular valuations is in place, then I think that advice is fundamentally wrong. If a particular fund is only valuing assets on an annual basis, given the volatility in values, the potential movement in values, then potentially there's a bit of merit to what he's saying. But certainly in our experience, the vast majority of funds now have in place what we would consider to be pretty sound processes, and therefore on the whole I would say that that advice is not particularly sensible.